you have questions about particular slides, just write down the slide number, and then at the end we can go back and I can answer that question. So the topic today is the exit strategy, selling your insurance agency or brokerage. Okay, so here's the agenda. We're going to first talk about planning the sale and general considerations that you should take into account when planning the sale. Then we're going to talk about how you develop an exit plan, what it looks like. Then I'm going to go into agency market value and what drives value in an insurance agency. And we'll go into some ways that you can enhance the value of your agency. I'll walk you through what is really the structured sale process, talk about working with advisors, and then leave you with some final thoughts. So every business owner goes through certain stages of ownership. So if you start a business, the first stage is obviously the startup phase. That typically takes 3 to 5 years. You're trying to get the business profitable, and beyond that, you're trying to get some additional capital so you can reinvest in hiring employees. And then once you get to a point where you've hired some employees, you got additional capital, then they go through what's called the growth stage. Now you've got enough to cover your salary, enough to cover employees. You start investing more into marketing. And somewhere down the road, hopefully, you continue to grow and you reach a mature stage of the business. That's when customer base is very stable, your employees are very stable. You're probably slowing down at this point in your business. And then inevitably, at some point or another, the business owner will need to exit the business. And whether you do that by selling internally or externally, it is an inevitable event in the ownership of your business. So what most business owners cover, they usually have a plan for funding their startup. They usually have a plan for marketing to grow the business. They usually have a plan for training their staff, a plan for tracking production, retaining their clients, maximizing contingent income. But what I've found is most agency owners do not have what's called an exit plan, how they intend on exiting their business and maximizing the value. So why should you plan the sale? So the starting point right now, there's different things you can do to improve the value. So by planning it out properly, you can work on improving the value. That way, in the end result, you sell for the best price and terms. If you plan it thoroughly, you can minimize your tax liability, which is important, especially if you are a C corporation. If you want to maximize the confidentiality when you do sell it, I mean, it's critical. If you have a business, you don't want the employees to find out. You don't want your customers to find out, so you want to have a structured process for selling it. You want to avoid ending up in a distressed sale situation. Health issues arise. I've seen cases where an agency owner passes away. There's no plan in place. The spouse was then in a situation where they had to sell it rapidly, which ended up in a discounted price. So if you have a good plan in place, even if in the event of your untimely death, then there should be a plan in place so that your spouse can step in and continue to either run the business or execute the plan. And finally, you want to ensure an overall smoother sale process and improve the post-sale stability of the business. But most importantly here, you only get one chance to get it right. So that's why it's very important to plan it out. Okay. This kind of looks at an overall of what are all the different consideration factors that you should take into account when trying to develop your plan. So the first part is dealing with financial issues. So you say you're selling your business. Are you going to have the income to support your lifestyle after you sell the business? Are you going to be able to cover certain debts that you may have? Are you considering this taxes on the sale? On the life side, maybe there's a health issue driving your sale. Is your family on board with the sale? Maybe you want to sell because of stress, and you want more time in your life and you're just burned out. On the bottom side of the graph, you see it talks about market conditions. So what is the demand for that type of agency? On the supply, meaning how many other agencies of that type are for sale in your market area? What's the capital market like? Meaning, is there available financing options? Can people go borrow money? What are the interest rates? What's the stock market like? And on the other side, we talk about what's the general economy, what's the regulatory environment. Just look at what happened to the healthcare and how the smaller agencies doing individual health plans. And then also, what is the competitive environment? We've had clients that sell because they look at what's happening in the market, how competitive it's getting, and they just realize they can't compete with the markets that they have. So all these kind of form a big picture of all the things that you can put into your factors to weigh in when may be the right time to sell. But what's the reality? The reality is, if you look at this graph, most of them are personal reasons. So retirement is the #1 reason here from our former clients. That percentage is probably going to grow over the next 10 to 20 years. The last couple of years have been a real financial challenge for many agency owners. When the times were good, they maybe bought commercial property, they over-leveraged themselves, and then things got a little bit tighter the last couple of years. They had to sell just to pay off some of their debts. Life change, maybe family was moving to a different area. The owner wanted to sell and start a new business, sell and go into a different career change. And then, of course, burnout, just tired of dealing with the details of running the business. I had an agency owner call me the other day. He said his web designer accidentally stole 2 pictures off the internet, and now he's being sued for $20,000. So it's little things like that. After a while, it just wears you out, and you know, get tired of dealing with it. And of course, unfortunately, there's health issues that can force a sale and force it rather quickly. So I've outlined some rules to follow. You know, these are guidelines basically. So the first one here is you want to set goals. You want to follow and stick with your plan. So you develop the plan and you want to stick to it and keep going back to it. Next thing is understand what the market value is and what drives value to a buyer. Third, work on enhancing the value of agency. So if you're not in the sell mode, you should be in the mode of trying to improve the value so that when you get to that point, you can maximize your return. Fourth, understand the sale process and how you can obtain the best deal. 5, seek professional guidance. And 6, be flexible and committed. So we're going to go through, you're going to see this slide again because I'm going to use it as a kind of a benchmark as we go through. We're going to talk about each 6 of these points. And the first one, obviously, let's look at what a structured exit strategy looks like. So here you see kind of a flow chart starting at the top. So what is the current value of your agency? And I'm going to go into this later, but really the best way is to consult with somebody who understands the market value. So if you go and find a good consultant to help you determine what the current value is, after that you look at what are my goals. So when do you want to retire or sell? What are you going to do after you sell the agency? Is the net gain from the sale going to be enough for your lifestyle? Is your family on board with it? All these questions come into play, and all these questions will change over time as different things in your life change. So once you've assessed your goals, determine what you want to do. Okay, I'm not ready to sell yet. I'm going to hold on to it, or I'm ready to sell, and in which case you go into the execute the sale process. If you're going to hold it, then you go back and you look at, here's the value, here's some areas that we see that we can improve the business. You start to implement some changes in your business. You want to track those changes, and then after a certain period of time, reassess the value and go through this process again and reassess your goals until you get to the point where you are ready to sell. So this is a very structured process of constantly looking at your business, understanding the value, working on improving the value of your business. All right, so let's talk about market value. So what is an agency worth? Simple answer, that which a buyer is willing to pay and a seller is willing to accept. The real question you want to ask yourself is how do you yield the highest price with the best terms on the sale? So, you know, when you go to sell it, if you're dealing with one buyer, what it's worth is what it's worth to that buyer. The best way to get the highest price and best terms is get your agency ready for sale, execute a structured sale process. So if you go and get a appraisal done on your agency, you're going to see 3 different approaches discussed in that appraisal report. So one is the income approach to value. That looks at the business as an investment to somebody and basically goes through and analyzes what's the return on that investment, you know, what is the value based on that investment and the earnings that it produces. The second method is called the asset approach. It looks at what is the tangible and intangible value of the business. And the third one is the market approach, meaning, you know, we take a look at your business, we look at other private businesses or agencies that are selling, what are public insurance brokerages selling, and you determine the value based on those three methods. So the reality is that the value to a buyer is driven by three things. One is the pro forma revenue and earnings. Two is the risk and opportunity of the agency or book of business to a buyer. And three are the terms of the transaction. So when I say pro forma, just want to understand that pro forma really means adjusted revenue and earnings, what it looks like from a buyer's point of view. But so you got three things: revenue, earnings, risk, opportunity, terms of the transaction. So in the industry, it's very common to want to value your agency as a multiple of revenue. The only problem is it doesn't really work because it doesn't factor in how profitable the agency is. It does work when you're just trying to sell off a book of business because the buyer has their own expense structure, so it's going to be completely different. But the reality is most agencies are valued on earnings because, one, it tells the buyer what return on investment they can expect. Nobody takes money and puts it into something and not expect some kind of return on investment. It factors in the buyer's ability to cover any financing and pay themselves a salary. And it's applicable for valuing an agency as a going concern, which means as an operating business with a fixed expense structure. So it's wanting to value on revenue is fine, but the reality is when a buyer looks at it, they've got to look at what kind of return on investment they're getting, and if they can finance it, how much cash flow is there to cover debt service. The most common earnings report used in pricing an agency is called EBITDA. That's an acronym for earnings before interest, taxes, depreciation, and amortization. A pro forma EBITDA is inversely related to the buyer's expected pre-tax return on investment. So what does that mean? If someone says, the value of your agency is 5 times its EBITDA, it means the buyer is expecting a 20% return on their investment. So I'm just going to say, generally speaking, most small agencies sell somewhere in the 4 to 6 times EBITDA range, and that's a pro forma EBITDA. As you get larger, the number can increase. It's really also driven by who the buyer is. As you get into being acquired by national brokerages and banks, the expected return on investment is much lower. So how do we determine the pro forma EBITDA? So here is a financial statement from one of our former clients. On the left-hand side, you see the income and expenses right off their tax return. So top line showing that this agency did $964,000 in revenue. After paying all their expenses on the tax return, he showed a profit of about $180,000. But does that tell the real picture of how much that agency is making? The answer is no, because the owner is taking out a salary, the owner is taking out certain discretionary expenses, and also if we're trying to figure out EBITDA, remember we got to add back interest on any business loans, any corporate income tax, depreciation and amortization, because those are not real expenses. So you see in the middle column here all the adjustments we made to this client's financial statement. We took out their salary. They happen to own the building, so we had to make a fair market rent adjustment. We took out their payroll tax. They had a loan that had to be paid off, so we wiped out the interest on that loan. And all the adjustments, so until you get to the bottom, now we've adjusted the financial statement. You'll see in the red box $412,000 or $413,000 in what we call discretionary earnings. That is, if someone bought this agency, they went in and ran it themselves, that would be the cash flow that they could expect. EBITDA is a little bit different, though, because it's really an investment cash flow. So what you actually have to do is go say, well, how much does it cost to hire somebody to run that agency so that I could just sit back and kind of manage it over, manage it from afar, and from that you really determine what the real EBITDA is. So we take the cash flow or the discretionary earnings, you back out what it really costs to hire a manager to run it, and then you come up with what we call the EBITDA. So hopefully that explains itself here. So a pro forma EBITDA is really an investment, it's an estimate of the buyer's investment cash flow. So again, it's if I hire somebody to run it for me, how much is it returning in cash every year? So the pro forma adjustments may include changes in revenue. So if your agency, you've got $5,000 a year in investment revenue, meaning coming from interest on your bank accounts, so they're going to take out that $5,000 in investment income because the buyer's not going to have that. If you sold a lot of life insurance, the renewals are very low on that, so they're probably going to wipe out some of the assume that revenue is not going to be the same the next year. It could be contingent bonuses, those sort of things. So they may go in to make adjustments to the revenue to show what it's really going to be going forward. Again, they may make some management expense changes. If I've got to hire somebody to run it, add their salary in, add any additional accounting fees, professional fees perhaps. So you got to make an additional investment. So you're operating on one technology system. They're a bigger buyer, for example. They're operating on a different one. They're going to have to bump up the costs of your management system. And they may even make adjustments for cost reductions from synergies. So you only need one accountant, perhaps, for running a bigger operation. So they may take out your accounting fees. Maybe you're overstaffed. They may take out some of your salaries. So there'll be all these kind of what we call pro forma adjustments. Now, the pro forma EBITDA can be based on a historic average. It can be based on prior year. It could be based on some projection. It really depends on what the trailing 3 to 5 years revenue and profitability of the business has been. If it's nice and stable, they can just average it out. But if your business is declining, that's going to project forward much differently. If it's growing, it's also going to project forward differently. So they can vary depending on the situation. Okay, so we touched on revenue multiples. We're talking about earnings. I just want to point out here exactly why valuing on the multiple of revenue doesn't always make sense. So here we have two generic agencies, both doing $500,000 in revenue. One of them has a discretionary earnings of $150,000. The other is netting $225,000. Somebody comes in and says it's worth 1.5 times revenue. Just throwing that out there as a number. So then, what does the deal look like after that? Well, the buyer, say in this example, puts down 20% or $150,000. They go and borrow 80%. And in this case, I did the financing. They go borrow from somewhere 8 years, 8.5% interest rate. That creates $103,000 a year in annual finance charges that they have to pay. So if you take that $103,000 out of the left example, now you're only left with $46,000 in earnings after paying off the debt. So that person is only going to make $46,000 over the next 8 years on that $150,000 investment. Or on the right-hand side, the agency is more profitable. So their $150,000 investment is going to return $121,000 a year in earnings after even paying the note. So you see already, you can see the big difference. Now let's look at it also as what's out of that cash flow that's coming to them, what is actually going to pay their investment. So if this person, instead of buying this agency, went and took a job somewhere, doing a similar job, maybe they can expect to make $60,000 a year. So we deduct that again from the earnings after debt and look at how much money is left over really to go back to their initial investment of $150,000. And then we just crunch the numbers. What's the cash-on-cash return on their investment? What's the total return on their investment? So in the case of the less profitable agency, you look at their actual cash-on-cash return is negative versus the other case. It's pretty high at 41% return. So to be honest, I'd say the one on the left is way overpriced. I'd say the one on the right is probably underpriced. So you see why this kind of points out exactly why trying to value an agency on a multiple of revenue really doesn't work. Okay, so we talked about revenue, we talked about earnings. Let's talk about risk factors. So what is a risk factor? It's really an element of the business that puts the future revenue or earnings at risk. So what are some examples of internal risk factors? The biggest one in the last couple of years is declining revenue. 4 years ago, the market was very good. The last couple of years have been not so good. I think things are stabilizing a little bit, but if you're trying to do a projection of what the business is going to do, in the last 4 years it's been declining, it makes it a little bit difficult to say that all of a sudden it's going to level out. So declining revenue does make a difference. Having revenue concentrated with carrier, producer, client, line of business, all those can be risk factors. For example, if you have a commercial client that makes up 35% of your revenue, and that relationship is based on the agency owner having known that client for the last 15, 20 years, that's a risk factor to the buyer. You've got to find a way to somehow transfer that goodwill and keep that client on when the business sells. Another big thing is not having good protections or control over the book of business. What do I mean by protections? Well, I mean essentially not having good non-competition agreements executed with all the staff, with the producers. You want to make sure that they can't, if they leave the agency, they can't solicit clients, they can't steal any information, they're not going to steal away your other employees. So you got to have the agency well protected. The other part of that is if you have producers, be careful giving them control over the book of business. I mean, because if you give them a stake in their book of business, a financial stake, that's fine. But if you say in your contract with them it says they own the book of business, well, you have no control over that. You don't really own that book of business, so it makes it difficult to sell. Next thing on the list is paying above market compensation rates to staff. I mean, this really could be a problem if all the staff are overcompensated. So say, for example, it's very good to have employees, stable employees for 15, 20 years, but what ends up happening is that over time they just keep getting more and more raises, and then eventually, if you look at the total payroll, it's out of line because everybody's been overcompensated over time. We actually had a client whose rule was every year or two to go in and let somebody go, take the worst, I'll say worst performer in the agency, and just let them go and go hire somebody else, because you wanted to, for one reason, it keeps your staff level, making sure that you have most productive staff, but at the same time, it's kind of keeping it at a current market rate that he's paying people. Okay, last three things I think are probably obvious. If you can't prove income and expenses, if you have low retention of clients, if you have a high loss ratio with carriers. So those are all internal risk factors. What are external risk factors? Well, the general state of the economy, changes in regulatory environment. Again, look at what happened to healthcare law. Changes in carrier compensation rates. Allstate has recently come out and said they're going to change how they structure their commission. That impacts the future of Allstate agents. Where we are in the cycle of premiums and hard and soft market cycle, how the stock market is performing, specifically if the buyer of your agency is most likely a public brokerage. They base what they pay on how well their stock's doing. Interest rates and availability of capital is very important because most agencies are sold to a private individual who has to go out and borrow the money to purchase it. So how do all these risk factors influence the sale? Well, obviously they can influence the price. They can influence the terms. For example, in that example I talked about the client representing 35% of the revenue. I mean, the term could be you're going to get paid on this client as it renews over a certain period of time versus just saying we're going to pay you, full price on the agency. So they may, the buyer may restructure some of the terms to share the risk a little bit. Third thing is it can make an agency unsellable. I mean, if you don't have protections over your book of business, if you don't own the book of business, it really makes it almost unsellable because the buyer can't go in and take over that business. So because, again, interest rates and capital is so important, I added a little bit of extra discussion here. So here again, let's take a simple example. Agency, $500,000 in commission revenue. In this case, they're netting 40% or $200,000, which is, again, throw up a price, $750,000. I'm in no way advocating this as a fair market value. I'm just keeping it simple. Say the buyer is putting down 20% again, financing $600,000. So we look at the bottom, and I've calculated out what is all the annual debt service that would pay based on borrowing $600,000 over either 3 to 10 years and how the interest rate impacts it. So if somebody borrowed $600,000 and paid it back over 3 years at 6%, the annual debt service is $219,000 a year. So if you take that out of the cash flow, you realize it's a negative cash flow on an annual basis. So the buyer's not even getting a salary. More so, not only is he not getting a salary, he's having to put more money into the business. So those terms obviously wouldn't work too well. Versus if you go all the way down to 10 years, the annual debt service at 6% is $80,000 a year. That leaves $120,000 to go back to the buyer. So, as you change the terms, it really impacts from the buyer's point of view, and not saying you, as the financing market changes, so meaning availability of capital changes, it actually impacts the buyer's perception of value because they really want to try and get the most cash flow, get the most return on their invested money. So, and I also want to point out, look at interest rates. So if you look at, just take, again, length of payment 3 years, 6% annually, that's $219,000 versus 10% annually, that's $232,000. That's even just by varying the interest rate, it makes a significant difference on the buyer's debt payment. Why do I point that out? Well, here's a 50-year chart of the federal funds rate and average inflation rate. So what is the most obvious thing on this chart of where we are right now? I can't get any feedback because nobody can talk to me, but the most obvious thing is we are historically the lowest interest rates we've had in 50 years, the lowest inflation rate we've had in 50 years. We know inflation's going up, so what does that mean is going to happen to interest rates? They're going to go up. What happens when interest rates go up? Well, the buyer's cost of capital goes up. And in that case, there's only so much cash flow for them to pay debt service. Therefore, it's inevitable that, it's going to have to drive down values a little bit because there's only so much cash flow and the debt's going to cost more money. So I just want to point this out because this is kind of a neat chart when you actually see what's happening in our market right now. Okay, so we talked about risk elements. What's the alternative? What's the opposite of that a little bit is what are some opportunities that could be available in an agency? So, you talk to every agency owner, they're always optimistic. They say, well, there's great opportunity in this business. And it could be true, but really what we're looking are, what are strategic opportunities that might be there? So if the agency has a unique market position, meaning it's a niched agency, they're the number one seller of a certain type of insurance product, they have a certain unique market position. There's an opportunity for potential cross-selling. That may come down to the buyer. If the buyer has an ability to go in and cross-sell between what the other agency maybe they own and the agency they're acquiring. If the agency has special or limited contracts with carriers, so a good example of that is wholesale agencies, MGAs can get different types of contracts with insurance carriers. Depending on the volume that they can commit to write, they can get even higher compensation rates than some of their competitors. So special contracts. And then the last thing is economies of scale. For example, you have a certain book of business with, Mercury. The buyer has a bigger book of business with Mercury. He gets a contingent bonus based on certain production and volume and everything. Well, by buying your agency and increasing his volume, maybe there's a strategic benefit in that he gets a bigger contingent bonus. So these are just trying to point out what are some hidden opportunities for a strategic buyer. The reality is buyers may pay more for strategic value, but typically the terms are going to be structured so that they're not paying it unless it comes to fruition, meaning, okay, we agree to pay you X more, but we're going to hold it out on an earn-out, so we got to prove that, that extra revenue comes in over time, and you'll get paid as we earn that revenue. Hopefully that makes sense. All right, so talking about agency market value, gone through revenue, earnings, how that affects it. Talked about risk factors. Let's talk about transaction terms. There's an old saying, you name the price, I'll name the terms. You want $1 million? Fine. I'll give you $1 a day for 1,000,000 days, and we'll make a deal. So terms make a big difference. You can never just look at price. You always have to look at what are the terms on that price. From a buyer's point of view, they want to be able to leverage the purchase. They'd like the seller to share in some of the risk. And they want assurances that the business and goodwill are going to transfer to them. So if you want an all-cash price, obviously it's not the same value to a buyer as a price in which you're willing to share some of the risk. So, what are the considerations that impact the value? How much money you want to deliver at closing? What are some terms that you're willing to hold a note on? So how long are you willing to carry paper for the buyer? Are you willing to share in some of the risk on an earn-out or retention based payments? So meaning earn-out means as the revenue continues over a certain period of years, you get a certain percentage of that. Retention means, as the account renews, you get a certain percentage of that. The easiest way to transfer personal goodwill of an owner is actually employ them in the agency. So are you willing to stay on as an employee and be an advocate for the buyer? And the last thing, of course, is non-competition agreement. If you're not willing to sign a non-competition agreement as part of the sale, what assurance does the buyer have that you're not going to go back and call your customers afterwards and try and re-solicit that business? So all these different considerations weigh into what is the real value of the agency. But don't forget, buyers want to be able to leverage the purchase. They would like the seller to share in the risk, and they just want assurances that what they're buying is going to be what it is now is what it's going to be in the future. So last thing I just want to point out, why use an outside consultant to help you determine the value and help you analyze your business? For the reason is, they understand how to interpret financial statements. Most likely, if it's a person that's consistently doing this on a regular basis, they've looked at a lot of agencies, looked at a lot of different agency financials, so they can give you input on where certain expenses should be. They can also assess all the weaknesses and strengths of the agency objectively. You run your business every day. You know the way things that you do. You have a certain reason for doing it that way. But if somebody has looked at a lot of other agencies, they may offer, well, here's a suggestion of how you may want to try doing this. So you get an objective opinion, and also they can be knowledgeable of the market conditions and market value as it is today. So the key is also use somebody that's knowledgeable analyst that's also engaged in selling agencies. The reason is there's a lot of appraisers out there, but they really have no idea what a real market value is. Okay, next thing, let's talk about, so we're going through the three things that really drive value: revenue, earnings, risk, opportunity, and then terms. So knowing those things, let's talk about how you can work to improve the value of your agency. So if you're not ready to sell now, that's fine. This is a good time to really look at your agency and determine what you can fix to make it improve the value of it. So two things again: earnings. So how do you increase the earnings? Obvious first way is grow your revenue while maintaining profitability. Easier said than done, but that's the obvious one. Second thing is streamline the operations to reduce your expenses. So if you're not paperless, put your office paperless. Try to automate as much as you can. Even nowadays with email and stuff, there's programs you can use that automate email, so your staff not always doing jobs that could be automated. Make sure you're paying fair market compensation. We talked about that. Develop cost-effective marketing strategies. So you should really be tracking where every marketing dollar is going, what kind of return you're getting. And then you got to look at, is this method worth the dollars I'm investing compared to this method, and kind of shift your approach. And last thing on there, watch your overhead costs, avoid long-term obligations. We've run into issues where owners have signed long-term leases on office space, maybe 5 years, and then the next year they decide to sell the agency. Well, it's not always true that a buyer wants to assume all of your long-term contracts for certain debts. So if you're planning out the sale, keep those things in mind, that when you go to sell, somebody may not want a 5-year lease because maybe the best buyer has an office in your area and they just want to consolidate it. Okay, so in my observations, having looked at a lot of agencies, I've come to the conclusion they fall into two categories. One is marketing-driven agency. I describe that usually as a personal lines agency or a niche specialty agency. The other is a sales-driven agency. What's the difference between these? Well, marketing-driven is all the leads are really coming from the agency itself, from the owners going out, driving phone calls, driving new business, and what you have in the office are really order takers. You have a lot of CSRs that are, completing the sale, servicing the customer, and that's really how it works. Marketing drives the new business. People in the office just take the business, service the clients. And what I've noticed is those type of agencies typically tend to be 10% or more profitable than one that's sales-driven. So what's a sales-driven agency? Usually it's a commercial lines agency, life and health agencies, where you're paying commissions to producers to go out and bring in business to the office. Is there a good way to do it and a bad way? No, but I think, if you're a personal lines, I think marketing-driven model is more applicable than a sales-driven model. Usually the larger agencies are sales-driven. Ones that are big commercial agencies, they tend to be sales-driven and have a little bit lower profitability. But anyways, just want to point that out. When you're looking at what is your business model? Who brings in new business? Understand that this is kind of where your profitability should be. A good reference to look at is every couple of years, a National Alliance produces a growth and performance standards book where they collect financials from agencies all over the country. Then they go through and analyze all the financials. They look at what's the average agency's revenue in a certain area, how much are they spending towards rent, how much are they spending payroll, marketing, sales, and all that. So it's a book that you can go and buy that shows you benchmarks for where your certain expenses should be. Then they also look at productivity, how much revenue you should have for CSR, things like that. Just throwing it in there because it's a good reference. I had more slides in here to talk about this stuff, but we decided that it would be best to actually separate that out and talk about it in a separate webinar, which we're probably going to do in a couple of months. So I just want to make note of that. Okay, so increase earnings, that's one method of enhancing value. Next would be minimizing the risk. So another obvious one to point out, build customer loyalty. So train your employees to provide the best service so that way your customers are loyal and they send a lot of referrals to your agency. Own, control, and protect your book of business. We discussed that, but this is really something that comes up more often than I would expect. So it is an issue across the industry. Diversify your markets and customer base. What's a good example of that? If you were a construction-focused agency 5, 6 years ago, business was great. All the agencies I've looked at recently that did that have lost about 50% or more of their revenue. They didn't diversify. The ones that survived were the ones that also had a balanced book of personal lines business. So you want to make sure that you're not too heavily focused. You want to balance out the agency a bit more. Cross-sell to build retention. That builds more customer loyalty again. Build in management tools. What I mean by that? Well, one of the biggest things is, as an agency owner, you've got a lot of the relationships with customers maybe over the years. So a big problem in selling it is trying to transfer that personal goodwill to a buyer, and that's the buyer's biggest concern too. So one way to kind of hedge that risk is to go ahead and train somebody in your office, maybe to take over some of those relationships, train them to do the things that you do. That way it's really a much smoother transition from a current owner to a new owner. Other things you can do, track key performance indicators in your business. How much does it cost you per lead? What's it cost you per sale? How much revenue you have per employee? What are your commissions per CSR and producer? Again, you can go back to the growth and performance standards book, look at what an average in the industry looks like. Just for example, commissions per CSR in a personal lines agency, you really want it probably in the 140,000, 150,000. And so, you want to make sure you're tracking the important things in your business because that'll help you manage it better. What's the old saying? Peter Drucker once said, what gets tracked gets managed, and I think that's pretty appropriate. All right, let's go. We're going to talk next about the sale process. So the sale process, or more accurately, the structured sale process. So once you've worked on your agency, enhancing the value, once you're ready to sell, then you enter into this phase. So I broke it down into 6 stages, really. First one is market preparation. Second one is soliciting buyers and disclosing them. Third is getting in offers and negotiating them. Then you go into due diligence, getting a contract, executing a contract, and everything that needs to be done after closing. So it's really the transition from start to finish of what happens. And again, this is a structure. This is the way it should be done, I believe. So what do you do for market preparation? What are we talking about? Well, the first thing you always want to do is prepare yourself for the due diligence. So the buyer's going to make an offer. It's going to be subject to you proving all the income, expenses, proving that the business is worth what you're asking for, it, stable book of business and everything. So you want to collect, you want to review, you want to make sure that you have financial records, commission records, maybe the bank statements, maybe go through your production reports, loss history, all these things that are going to come up and be part of the due diligence. Look at them now, organize them in advance, or have somebody help you do that, because that will minimize your chances of something coming up later that blows the deal apart. You don't want to get into it 2 or 3 months with a buyer, and then something comes up and they want to renegotiate or they want to walk away from the deal. But also getting organized in advance speeds up the whole process, moves it forward quicker. The next thing that prepares what's called an offering memorandum, or as we call them, the pitch book. What it is a detailed summary of the agency. You want to tell a story to the buyers. Once you disclose them, you want to have a way to tell them a story. So it goes through what's the history of the agency, who are the principals of the agency. Tell them about your employees, tell them about your marketing, your growth, your book of business, the financials. So you're giving the buyer pretty much everything they really need to know about the agency, so that way they can have a quick way to make a decision right away if they want to purchase it. So it should be a good, compelling story. It should educate them. That way they jump on it. They want to come in and make an offer for your agency. The third thing here is buyer research. So the goal is to identify the most probable buyers for your agency. So there's a whole array of different types of insurance agencies, captive, independent, retail, wholesale. There's different buyers for each type of agency, different buyers in different markets. The goal is to do some research, understand who's going to really be the buyer for that agency, and then develop your marketing strategy. How are you going to get their attention? How are you going to get them to discreetly attract their interest, so that way you have multiple people looking at the agency at once? So let me go back real quick. Again, 3 things of preparation: pre-due diligence, creating an executive summary, doing your research on the buyers. So once you're ready, then it goes into getting the buyers to contact you, perhaps contacting them if you have an intermediary, disclosing them. Goals, really 2 things. You want to always protect the confidentiality of the sale. I know owners sometimes, most of the time owners care, sometimes they don't. I always say you want to protect confidentiality. You don't want your employees getting nervous if they find out. You don't want marketing reps finding out. So you have the buyer execute what's called a confidentiality and non-disclosure agreement, and it should be drawn up by an attorney, or you want to make sure you're not just finding it off the internet and it doesn't protect you, because issues can arise if you don't have one executed. So part 2 of that is you want to filter the buyers based on their financial strength and their experience. So you want to know who you're dealing with. Do they have the money? Do they have the experience to take over that business? And the reality is, if you put your agency on the internet, you're probably going to get 100 different people calling you, and you're going to have to find a way on your own to filter through and figure out who are the real prospects, who are the real buyer candidates. So goal 3, from my point of view, as someone who's running a structured sale, you want to create an auction. So you want to get all these potential buyers that are serious candidates, and you want them to basically bid on the agency. So that way you actually get the best market price and the best market terms. All right, after we disclose them, then it goes into the offer. So I want to point out there are different types of offers that are made, and here are the 3 ones. There's what's called a term sheet, which is really a simple document. It could be a letter saying, "Dear so-and-so, thank you for our conversation. I'm interested in your agency. I'd like to propose in terms of, I'm going to offer you this much." So it could be a half-a-page letter just doing an introduction. It's a non-binding agreement, which means that the buyer doesn't have to follow through with it. They're offering you something subject to certain things. They can walk away at any time. The next is a letter of intent. It's a little more detailed. It's also a non-binding letter of intent, but it's detailed. It says, here are the terms. Here's the price. I want this much time for exclusively to go through and do due diligence. Could be a month, 2 months, 3 months. I don't want you talking to anybody else. Here are the things we want to see. I'd like to, it goes through pretty much everything that is going to be in a contract, all the details. But it's still non-binding. At the end of the day, if the buyer's not happy with their due diligence for whatever reason, they can walk away, and there's no penalty. So you could have wasted a couple months of your time. The last offer is a purchase contract. This is going to lay out, no matter what, you got to go through a purchase contract. But it's going to lay out all the details of the purchase and sale, the price, terms, everything from start to finish. It's a binding agreement, though. There's usually contingencies in it, contingent on due diligence, contingent on approvals from financing, et cetera. But it's a binding agreement. If you're working with a lender, this is what they want to see. They don't want to see a term sheet. They don't want to see a letter of intent. They want to see a purchase contract, because it means, okay, parties are in agreement. Here are the terms subject to financing. And that's when they want to step in and help you. I was asked to point that out, by the way. Okay, what are some key considerations when you look at an offer? What is the purchase price and formula in terms of payment? So how much money are you getting at closing? Because I tell you, the industry average is 70 to 80% of the purchase price is usually delivered at closing. I've heard plenty of stories where the buyer wants to come. Actually, I've had buyers email me and say, well, on this agency, we'll offer you $10,000 down, and we'll pay the other couple $100,000 or whatever over 5 years. You want to make sure you understand what's the real market rate. If the buyer needs to come in with a lot of risk, it's usually they got to put down 70, 80%. Then what are the terms of the balance of the payment? So is it a fixed payment over time that you're getting paid? Is it a contingent payment based on, as we said, revenue staying the same way it is over the next couple of years, certain accounts renewing? Make sure you understand how you're going to be paid. Always look for what's called a clawback or offset, meaning you get 70%, 80% up front. We're going to pay you this X amount over a certain period of time, except if X, Y, Z happens, then we're taking off the note. So this kind of sometimes can be hidden as to how they can reduce the price. So what we always say in the industry, there's three things. There's guaranteed price, expected price, and potential price. So always look for what is the guaranteed price, what do you expect, what's the potential price if there's an earn-out. Okay, guarantees and security on payment. Again, if it's an individual buying the agency and there's a note involved, you want to personally guaranteed. Can you get a security on the note, meaning will they collateralize it? I'm not sure. What are the contingencies to the agreement? So the contract subject to financing approval, subject to carrier approvals, etc., just so you understand what's going to also be involved in the sale. So what's the period of exclusive dealings? So the buyer's going to ask for, and this is very reasonable, I need so many days to conduct my due diligence, get the affairs in order. Could be 60, could be 90, depends on the size of the deal. But they're going to spend money, spend a lot of time, resources, doing the due diligence, getting the financing ready and everything. So they want a period where you're not dealing with other buyers. So just understand what that is. Also understand what is a reasonable amount of time. And I'm just telling you, 60 to 90 days is a reasonable amount of time. Okay, due diligence. Due diligence is the buyer's process of verifying the quality and condition of the agency. Oh, I'm running quick. I got to hurry up. I'm running out on time here. So there's really three phases in a professional due diligence. Financial, meaning verifying revenue and income and expenses. Operational, meaning they look at the employees, they look at all your contracts, book of business, all the sorts of things that go into policies. They look at everything that deals with the actual operation. And the third is legal, just making sure the agency is in compliance with laws and everything. The attorneys usually handle that. So the due diligence process can vary from a few weeks to a few months. More importantly, it can make or break a deal. So you want to be prepared in advance, so that way you get through the due diligence, nothing changes in the offer, and you just keep moving forward. You don't want to have to start over again. All right, last couple of stages here, pre-closing. So once the contract is through due diligence, there's only contingencies really left. So if there's financing, it's just getting the financing approved, carrier approvals. Could be execution of employment agreements near closing, so they want to make sure there's contracts in place. Drafting the final closing documents, not much to talk about there. And then post-closing, you're going to have to help transfer the business. So there's going to be, it could be months, could be 2 months of money still flowing into your accounts. You're going to have to make sure that that gets reconciled, turned over to the buyer. You're going to have to help them transfer the business. In some cases, you may be staying on as an employee. Typical transition period where you offer to help is probably a month up to a couple of months. Usually buyers after a couple of weeks said, okay, thank you very much. I got it from here. So just giving you an idea of what are some typical time frames. All right, I got to rush here because I'm at 50 minutes. Okay, so last thing, the second to last one here, seek professional guidance. So talking about laying out 3 different advisors that should be on your team. Merger acquisition, you call them a broker, intermediary. Their role is really to advise you on the market value, help you build a plan, sell for the most value. When you get into the point of selling, they're going to manage the whole sale process for you. Then you have your accountant who's going to help you with the due diligence. They're going to advise you on any tax implications of the sale, capital gains, how you're going to be taxed on different parts of the sale price. Attorneys will assist you with negotiating typically any representations, warranties, any indemnifications you may have, just to try and protect you from a legal standpoint. But whoever your advisors are, there's more. There could be a financial advisor involved. There could be an operations consultant involved while you're trying to get it ready. Just make sure that you're dealing with people that know your business, know the industry, know the whole process. I mean, you want to make sure that they really are a deal-making party to the transaction, because some attorneys could be different. So I'm just outlining all the different value that advisors add. We talked about most of these. Two on the right-hand side didn't really talk about. The advisors really help reduce your stress. They help take away some of the time involvement for you. More importantly, a good advisor makes the deal happen, helps you get the most value, and the cost of using advisors is really much less much less than the value you gain from it. Okay, last thing here, final thoughts, what you should expect by executing a structured sale process, by preparing an exit strategy. It's going to take time, it's going to take resources, there's going to be issues that arise along the way. Nothing ever goes as planned. Just be flexible. It's going to be stressful and emotional. I mean, most likely, if you've owned your agency for a long period of time, this is a serious process. This is a serious transition in your life. There's going to be emotions involved. Just understand that. More importantly, though, you're going to end with a much better result if you go through this whole process of developing an exit strategy and following it all the way through. So thank you for your time. Hopefully this was useful. I'm pretty close to the time frame. I was trying to stick to that 45, 50-minute time frame.
Thanks, Mike. Can you hear me on the line now?
Yes.
Okay. I have a couple of questions that have come in, and so I'd like to go ahead and pose those to you. Looks like Greg Wild has posed the question on slide 18, where you referred to changes in carrier comp plans and how that affects market value. He was curious if you could comment more on your opinions of the changes that Allstate has announced to their agent comp plan.
I'll say in general, so if I kind of understand the basics of what the changes Allstate has made. They said they're making it more so that it's performance-based. So the question is, I'm guessing, is how does that impact the value? It just makes that, so if you're going from a fixed 10% commission to, say, 8% plus a variable amount, I'm not sure what the full amount is, but it just makes it so, it makes it a little more difficult for the buyer to predict what the revenue the next year is going to be. Hopefully that kind of addresses the question that you have.
Okay. And just one second, I'm just checking. How you believe the market will impact the market value of the agency for someone that might be trying to sell or buy in that case. So yes, I believe you answered the question, but we can always provide some follow-up too as well if Greg would like more information.
Yeah, let me say this. All state agencies, I mean, they're, except I'm going to exclude, so Florida's been a little bit different here, but Allstate is a standard market business. The agencies tend to have very stable revenues, so they've always commanded typically a higher value. The only thing is if they're changing your compensation rate, it changes what the revenue is probably going to be after the year after they do that. So what is the formula? How much is it going to change it? I can't say without knowing a little bit more, but just understand it's just going to change what your revenue is the year after, the year after they make their changes in compensation. So the buyer can't 100% base it on history. They got to base it a little bit on the future too.
Okay. Okay. Well, Mike, thank you so much for your time today. We really appreciate you providing this information. I know a number of attendees have hung on to the very end, even though we went a little bit over, and I appreciate that. I did want to let everyone know that we will be sending a follow-up email with a link to the recorded version of this webinar in addition to a PowerPoint slide. And in that follow-up, we will have an invitation or a link where you can register for Mike's follow-up webinar that we'll be hosting in February. Mike, one additional question just came in from Drew, and Drew wanted to know, how does EBITDA multiple change if buyer is a bank without insurance ops, bank with ops, and a large broker?
So how does the EBITDA change if the buyer is a bank or a large brokerage? Well, I mean, it's their evaluation of what the EBITDA, the pro forma EBITDA is going to be different than a different buyer. So if it's a bank and they have no agency operation currently, they're just going to have additional management expenses. So their EBITDA is probably going to be less than what somebody else might calculate. But the bank is typically expecting a much lower return on the money that they invest. So, for example, the bank may say, well, the EBITDA instead of being $600,000 is $500,000, but instead of offering you 5 times, we're going to offer you 6 times. So in the end, the price could be the same. That makes sense, because they're going to have a higher cost structure, but they're going to be looking for a lower return on their investment.
Okay. Okay. Great. Well, that looks like that is all of the questions that were posed on this session of the webinar. If you do have additional questions, of course, you'll be able to respond to the email, and you will also have Mike's contact information where you can reach out to him directly. And I very much appreciate everyone attending and look forward to our future webinars. We'll be hosting these at least once a quarter, but we possibly will be doing some additional ones since there are so many topics to cover right now. You can watch your email and watch the website for those announcements, and we'll be getting those out on a regular basis. In the meantime, have a great day, and we hope you have a happy holiday.
Thank
you, everyone.